Mhm. Hi, good evening. Thank you for coming, everybody. So we are very excited because this is an ETF that we is already in offering. So yesterday onwards, until next Wednesday, you will be able to subscribe for this ETF. Launch price is $1.000 per unit. So basically, you can go through Phillip Securities to subscribe for this. There will be more details later. But basically, first of all, today, which will be about, I target for about 40 minutes presentation for this. First of all, I will talk about China. Why China? Right? And after that, why China A-shares? Like A-shares, I'll explain to you what A-shares is about. And once you have understood the China A-shares investment phase, then we will talk about the product. I think that is a sequence that makes sense. Okay, so without further ado, I will start with why China. Why China? Most of you hear about headlines. Headlines are what control readers, and usually headlines are bad. That is why when you read about China, wow, property developers having problems, right? And kind of slow down, then through political problems, as in we have the trade war with the US. But if you think more deeply about it, why is there a trade war? Because why? Because China is number two, right? So sometimes people are concerned when number two is rising very fast. So, okay, I will talk about the fundamental case for China. Okay. Okay, the first next page. Right. First, China. Let us appreciate the trajectory of growth for China over the last 20 years on the left-hand side. Sorry, over the last, since 1960s until 2020, right? So there's many decades. The red part shows the contribution of China's share of to global GDP over the years. So as you can see, it has accelerated since the years 1990s onwards. Every part is now about 20% of global GDP. The one below in blue is basically the US share of global GDP, right? As you can see, that growth has been very enviable. Hundreds of millions of Chinese in the mainland have been lifted from poverty, right? Over the space, or it's the greatest economic miracle over the past few decades. Right-hand side, achieving power adjusted parity GDP, right? What it basically means is that the buying of 1 unit of GDP on China, what it can buy in terms of goods, that's basically purchasing power adjusted parity. So basically, the buying power of that particular dollar amount in GDP. Now, if you adjust all this, the buying power adjusted GDP, actually China, which is shown by the red here, is already past the US in terms of the buying power of the GDP, right? Since 2016, it's already past the US, which is in orange, right? So what I'm trying to show here is basically the check record over the years in terms of the economic growth itself. Next slide. Now, we look at the capital markets, mainly the stock markets, right? This is left-hand side shows the total market value of major exchange, the companies in the major exchanges around the world, ranked from the top 10 basically. So as you expect, the US exchanges, New York Stock Exchange, Nasdaq occupy the first two slots. What I'm showing here is the red highlighted one is basically the two mainland China exchanges, right? Shanghai and Shenzhen Stock Exchange. The combined value of the stocks as listed inside these two exchanges actually exceeds more than 10 trillion US dollars already, right? So basically, if you look at the rankings of the major stock exchanges, based on the total value of the stocks listed inside the respective exchanges, Shanghai is number 4, and then Shenzhen is number 7. These two together make China basically the second largest equity market in the world. If you were to include Hong Kong as well, that's another $3 trillion, right? So we appreciate, for example, how big Hong Kong stock exchange is compared to the three mainland exchanges, right? So Hong Kong is smaller, right? Smaller by Shanghai is smaller than Shenzhen, right? So that's to appreciate the size of the mainland equity markets. Because I suppose you all may be more familiar with Hong Kong, right? So later I will talk about how Hong Kong, the mainland shares before Hong Kong, how we compare with the A-share that I'm going to be talking about. The A-share are mainly those that are listed on the mainland. Now, if you look at the stock market size, the total value of this companies listed on these various exchanges, as a percentage of GDP, right? So this is shown in another form. China is shown in red. This one is US in orange. So you can see that the US, for the US, the total value of the companies listed on the US exchanges is already about 100% of GDP, right? So US really is it's a listing haven, of course, right? So a lot of companies have listed themselves on the US exchanges, and then therefore they are already there, right? Now, China, in comparison, is around about 70% of GDP. What that suggests, I guess, is there is still more room for growth in terms of new listings on the two mainland exchanges, right? A lot of companies possibly, if you look at the overall GDP, a lot of companies probably are still private, they haven't listed, right? The capital markets still have room for growth. Okay, so the long and short of it, this two slides is this, right? Size is important for two reasons. It's not just one. Well, first of all, critical mass, right? Because, for example, China is now trying to transit to a so-called gross circulation economy. Gross circulation is no longer so much dependent on exports and manufacturing, but also on internal consumption, right? So that's why you have two circulations generating the GDP, two engines of growth. That's how they are transiting to, right? Are they able to make it happen? First of all, they are big enough that they can make it happen. For example, the purchasing power of as I've shown, the GDP is already the largest in the world. So they can make the internal consumption model work, right? So that's one, critical mass. Now, two, I've shown you over the first slide that I think that China has grown from such a small share of global GDP to now 20% of GDP. And that takes tremendous energy and willpower of the people. Now, do you see that it can really, I wouldn't put it past them, to get past the current programs. The growth track record is there, right? So when you look at, say, a company, right, you also look at the track record, right? Right, we have that what is already there, that's already the critical net that's already there in us, have the ability to sustain itself after running through some times, right? So some of you may be, we have read about this story several decades back. I think shopping from down to Singapore. So she had conversations with our first Prime Minister, Lee Kuan Yew. So she was impressed with how Singapore had progressed over that. That was around the late 70s to the 80s, I think. So she was very impressed. And Lee Kuan Yew was to him and approached him and said, you know, basically, what we have in Singapore are the offspring of colonies. But what you have in mainland China are the elites and the mandarins, the offspring of mandarins. So he was confident that China would be able to prepare itself, and indeed they did. I think the same logic applies today. Next slide. And next slide again. Right. Some of the points to note about China AHS, if you can see the last row, MSCI China AHS. When you say correlation, meaning that the region of the market, the performance of the market moves at a different cycle from the rest of other markets that you're comparing it with. When that is so, when that rhythm is different, then basically you are able to achieve the benefits of diversification, right? Diversification means that you diversify away the risk that we all perform out at both parts at the same time, right? Okay, what is both now, of course. Well, if you compare that, the MSCI China ETF, it has no correlation with the rest of the major markets here as shown, such as the UK FTSE, such as France, CAC, DAX, Nikkei, for example, right? So, anything that is below 30% will be considered low correlation, right? So that's what I'm trying to say, that diversification-wise, HS has the benefits of occupying something, it has diversification benefits of being a strategic part of your core portfolio. Next slide. And this is the PE ratio of the various major markets. The China A-shares, which is represented by MSCI China A50 index, it is trading at a low level on two grounds, two phases. Firstly, comparison against the rest of the major global markets. For example, S&P is trading at an MET are both trading at over 20 times price earnings ratio, right? So China A-shares are around 10 or below in terms of PE. That's one. Secondly, is that on a historical basis, it is also trading at definitely below historical average when compared to its own historical level. Probably we are 1 to 2 standard deviations below that long-term mean, right? So whether you compare across markets or compare against its own history, basically the MSCI China shares are at an attractive price level. Next slide. What is the US, right? People are always conscious about whether, there is value. There is a fundamental case. Is there a catalyst, right? If there's no catalyst in my review, then perhaps that's a lot of people that are concerned about. When you look at China, I think part of the narrative nowadays is also about, is there a catalyst, right? And people look at whether the government is looking at providing support for the economy because there is undeniably having a slowdown or a transition, right? And I think in recent years, basically the government has been trying to look at deleveraging. They've been trying to look at quality growth. On the mainland, quality growth has been the focus. When we look at quality growth, so there are few, it's never been fully defined. But quality growth, I would interpret it as firstly, net prosperity, common prosperity, wealth is spread among the population because it's such a huge population. Secondly, innovation-driven growth, right? And that's becoming increasingly important because it has to develop its own ecosystem. Production ecosystems, consumption ecosystems, everything, right? So innovation is important, quality-driven growth. And is China able to, it doesn't have the capacity to boost stimulus. So this is what this slide is trying to show. It has the world's largest forex reserves, almost 3 times compared to the next biggest, which is Japan. China has over $3 trillion in forex reserves. And in terms of the debt headroom, it is shown here, the government debt as a percentage of GDP in China, it is by no means very high compared to other economies that you see here, right? So, for example, Japan is definitely one of the highest, right? And even advanced economies are easily over 100% of GDP, right? The central government definitely has the capacity to increase debt if it wants to. As I mentioned, over the last maybe 3-4 years, the focus has been less about that though. But next slide. In recent months, I think there's been some impetus to action. I think there is growing emphasis that they do not want the capital markets to have a sustained power momentum, right? So as you have seen. And in terms of some of the policies, I think the policy impetus to boost the market, to boost economies and so on, I think it has been coming forth more increasingly. If you look at the monetary policy, the central bank has cut the reserve ratios for the banks. So that actually releases something like 1 trillion additional for the banks to lend out to people, right? That's on the monetary policy side. Fiscal policy. Fiscal policy means the government spending, right? So what have we been looking at? For 2024, it has been announced, right, that there is a 3% budget deficit that will be incurred. Deficit is clear in a sense for the people. Deficit means that the government will be spending more than it takes in, right? So that's deficit spending. So about that difference will be about 3% of GDP, 3% budget deficits. And we have also previously announced that they are looking at building social housing to the size of about 1 trillion yuan. Social housing meaning, HDB, right? HDB social housing. That's an analogy for that. So basically, the government is looking at ways to take over from the private developers, especially those that have problems, right? That can no longer do it. Other measures would be market support measures. Market support measures, such as in recent weeks, you have heard about that they have tightened trading restrictions to stop short selling, right? Especially, I think those of you who really don't focus on the bonds funds in terms of that, to make sure that there is no abusive short selling. And at the same time, on the demand side, we have leaned, the authorities have leaned on the state affiliated funds to look at buying more of the market to support the market, right? So those are definitely by no means smaller, those state funds, right? And basically, this is a pinpoint approach. If you look at this basically on the demand side and the supply side, we have been looking at ways to boost the markets. Okay, next slide. At this point, I just want to, so basically those first few slides I've been covering is the investment case for China. Now, China shares actually, they are traded in a few markets. Asia's market is the biggest, right? Shanghai and Shenzhen markets. These are the two main Asia markets, right? And now there, examples of those that trade there will be the major SOEs, state-owned enterprises, right? Then examples of major stocks there will be like the world's biggest spirits producer, CATL, the world's biggest electric vehicle battery producer, BYD, most of you are familiar there. Okay. Now, Hong Kong is where a lot of people will be familiar with, right? Quite a number of shares listed there as well. Shares meaning that the SOEs, besides being listed on the mainland, they also list out of their classes of shares on Hong Kong, which we call H shares. It's basically trading the same company, right? And at the same time, PH refers to those private companies, like private mainland companies that choose to list offshore. So big examples of that easily will be Tencent, right? Tencent is the one that most people are familiar with. And then in recent years, also Alibaba, Baidu, right? They have also listed there. And with the last one is ADRs in the US. So US is another key market where a lot of, especially tech stocks and EV stocks, really list there, right? So examples would be Alibaba, Baidu, right? And in recent years, I think you have heard that the US has been camping for some of these ADRs, China ADRs that's listed there, which is the reason why, for example, Alibaba actually tried to have another new listing in Hong Kong. Okay, so there are a few categories or markets that human shares can actually choose to list, right? So why A-shares, right? Well, A-shares, I think I showed you just now, they offer a much bigger choice of different sectors and companies that are basically based on the mainland China, and they benefit from different segments of China growth. Things like high-end manufacturing, domestic consumption, technology, healthcare, right? And in terms of the size, I think if you remember, Shanghai plus Shenzhen together is about 10 trillion US dollars. Hong Kong, if you remember, I showed you the comparison there is about 3 trillion US dollars in terms of the total value, and more of them are China's stocks, of course. Right? So in comparison, you can see that China mainland shares will offer a bigger selection, and it's a much bigger market, right? In terms of the stock selections available, sector exposures available, right? So that's one. Secondly, I think in recent years, some of the offshore companies especially the mega tech companies, they suffered from some regulatory tightening by the Chinese government, right? And as a result, as you see later, actually some of the offshore and index that actually comprises the offshore China company performs much worse than an index that just captures A shares alone, right? In fact, if you think about it fundamentally, which are the main China shares that mainland retail investors should be invested in? It has to be HS, right? Because several years back, HS was the only market that we can invest in. In fact, today, if you look at HS, China domestic shares, about 80% of the trading volume comes from mainland retail investors, right? That shows that mainland retail investors are a major force on the HS market, and they hold a lot of the shares. Comparatively, offshore markets such as Hong Kong, definitely much less, right? Now, if there is policy support, if the government is framing policies to support the economy and support the markets, which one do you think therefore would be took as a third priority? Definitely HS, right? Because in the name of common prosperity, that philosophy, you would think definitely therefore that will have these retail investors in mind, and where would these retail investors, non-retail investors, where would their money mostly be in Asia's? Next. And here now we come to the ETF that I'm looking to introduce to you today, which is the Phillip China Universal MSCI China A50 ETF, right? Breaking down the name of this ETF that we are listing, Phillip China Universal. So basically, it's a partnership between ourselves and China Universal Asset Management, which is one of the largest fund management companies listed in the mainland China, right? This ETF basically you'll be feeding into the mainland listed ETF on the Shanghai Exchange. I'll show you a bit more about the structure later to facilitate understanding. Basically, yes, so as it says here, we invest at least 90%, right? Mainly into the underlying ETF that's managed by China Universal. So in this way, basically, we will be able to track the index that is known as MSCI China A50 Connect, right? That's the index that is the benchmark for this index. And index provided as MSCI, right? In China A, right? So China A shares 50 of the leading stocks, right? So basically, I will just look at a bit more for the index in detail. 50 leading stocks in China's A shares across the big sectors. Okay, next slide. Who is it suitable for? So for those who want exposure to China's A shares market. I think it is probably still quite inconvenient for investors to buy into China's A shares now, right? So this, first of all, gives you a transparent and quick way at just one click to buy into China's A shares in a diversified manner into the leading companies. So liquidity, right? So this ETF, you know what you're getting into, and it's rules-based. You'll be buying into 50 leading companies on the mainland China A shares. Yeah, okay. And of course, the rest are easily understood, right? ETF, I think most of you are familiar with that, right? Okay, next. This is the product summary in more detail. So some things to highlight is probably that it's trading on the FGX. So we are waiting funds that we release on the 20th of March, which is about 2 weeks from now. So we close offering next week, right? But we release after that 1 week and another week after that. So it will list on SGX, so it's very easy for you to buy. It's available in Sing dollars and US dollars. So most of you probably have natural Sing dollar exposure. So it's easy for you to either subscribe to an IOP, or you can also buy it on the Singapore Exchange when it's listed easily, just like any other ETF. Right. Now we are launching the offer at 0.000 per unit, $1 per unit. So everybody comes in during offering period from now till next Wednesday at $1. Next. It's an EIP. So EIP means it's very easy to buy, right? Management fee. So what we're trying to do here for this ETF that we are starting is it's a feeder market structure. So when we talk about feeder market, basically investors would the master also charges a fee, right? And what we're trying to do here is to make the feeder, which is what we are listing here, right, as cheap as possible, 0.01%. Right? I don't think you will find any other feeder ETFs on the market in China that is at anywhere near this. Okay. And what we're trying to do here is basically facilitate Singapore investors access to China A shares in almost the same cost in terms of management fee as what China mainland investors incur when they buy into the same China Universal A-shares ETF on the mainland itself. Right? Almost equivalent cost in terms of management fee. Yes, so PhillipCapital is a dealer, so you can easily subscribe. Okay. The offering here is 4 to 14 that Phillip Securities closes on 13th at about 5 p.m. So do subscribe early. Okay, and listing is 20th March. Okay, next slide. Just talk about MSCI China ETF because I guess it may not. It gives you a flavor, right? How is the index compiled? How do they select? Well, 50, right? You will compile 50 stocks. But how are these 50 stocks modeled by the index provider MSCI? Right? Okay, next slide. Well, if you look at focus on this chart, basically it starts from the broad China A-shares index from MSCI. So basically, A-shares index from MSCI would include the shares, the major shares listed in Shenzhen and Shanghai Exchanges. That's the A-shares, right? So that's the starting point. And the MSCI, in order to compare this index, what it does is it selects the top 2 leading securities. Leading means the biggest market value, right? For each of the 11 sectors. The 11 sectors inside the so-called big classification, right? So 4 top securities and 11 sectors. So there are already 22, right? 22 stocks in this way. And finally, the remaining 28 that add up to 50, basically is just chosen from the biggest companies, all, right? So essentially, what you end up with is a selection of basically the companies in terms of market, free float market capitalization. At the same time, there is some diversification because of this deliberate process to select leading stocks from the sectors, each of the 11 sectors. Okay. Now, if you look at the next slide, this gives you a flavor of the sector allocation. Okay, for this index as of December 2023, right? Financials 19, infotech 15, consumer 14, industrials 14, materials 10, healthcare 8, and so on. Real estate 1, okay? So not very too much. And the real estate is small and is it's not non-private companies, state-owned enterprises, right? So safer. So if you look at this sector's allocation, because of the deliberate way of selecting and ensuring that there is adequate sector representation, none of the sectors take up more than 20% of this index as of December 2023. top stocks is shown here, right? Some of the names may be familiar to you, some may not be because I guess a lot would not be familiar with China A shares at this point. CATL, I think a lot of you might be aware, right? BYD, of course, right? Some might be familiar with Zhejiang, right? All of these are actually leaders in their own field, right? So, for example, Zhejiang is a top 10 global miner in the respective areas that you focus on, which is copper, zinc, and zinc only, right? Okay. Foxconn Industrial Internet is actually a subsidiary of Foxconn. Foxconn with a local partner. So this is not whole Foxconn. It's just the Foxconn that is on the mainland that focuses on industrial automation, right? We call it industrial internet. Basically, they are trying to facilitate the modern factory through sensors, robots, cloud computing, right? This kind of to basically, I think some of you, if you go to China, right, you see almost workerless factories in some places, right? So Foxconn in that internet is in leading player globally in that, right? Large share position. So you see some of these infotech names are not the familiar infotech names that you might all be familiar with the so-called platform players like Alibaba and so on. Right? These are more, when you say infotech here, right? You have Foxconn Industrial and you bring smart manufacturing. Large share position, high-end manufacturing for end customers like Apple and other big MNCs, right? Infotech, Long Green Energy, right, is a major solar equipment producer, right? Highly cost competitive, right? So it's basically, you appreciate that basically a selection of these top names enable you to write on the various areas of China's new economy, right? The leading areas of the transition to a new economy. Okay, next. And this chart is important because it also reinforces my earlier point about why A shares are preferred, at least in terms of the track record historically. From 2014 to 2023, the first four that you see here, the red ones and the orange ones, they are basically the performance of China A shares. So depending on the flavor of the A shares index, the one that is the best is shown China A50 Connect Index. Right, this is the one that today I'm talking about, right? So that has actually delivered something like 80% return over the last 10 years from 2014 to 2023. The last two, the green lines, is basically one is China All Shares, MSCI China All Shares. Next one is just MSCI China, right? Similar in concept. Basically, what these two green lines, the indexes tries to compile is a selection of the major China stocks listed on not just the mainland, but also offshore, such as in Hong Kong, such as in US, right? Now imagine over 1 year, $1 that you put into such an index has come back to $1 for something that invested into just that section of China shares invested in all the exchanges, right? So you have done much better by buying into China AHS alone, right? Okay, next slide. Okay, I won't go too much into detail except that just to give you an understanding that the return on equity of the main constituents inside this index have been pretty consistent. Anything above 10% for return on equity is considered relatively attractive. So you can see, appreciate here, the index constituents ROE on average have been able to sustain above that, right? Okay, next slide. And no, I'll just skip through that, okay? Because I want to give some time for questions next, and also help you understand about this feeder structure, right? So I promise I'll give you some flavor about China Universal, because this is a feeder feeding into a master. But basically how it works is the one that we are listening to Phillip China Universal MSCI 50 ETF. What is good with doing is primarily investing into the master that is listed on the Shanghai Exchange, right? This is this one here, right? And it's through this link, ETF link, that's established between SGX and mainland China. So SGX and MAS have been working hard to ensure that investors are able to, through such an ETF link, be able to invest into China A shares, right, through ETFs, right? So we are actually using this ETF link that has been developed by SGX and MAS last year. Okay. And for this master ETF that's managed on the mainland, which we are primarily holding in order to get exposure to the index MSCI 50, right? Just to give you some details about that master ETF, next slide. Okay, this is China Universal, right? Basically, fund manager in mainland China, right? That will manage in total assets is about 1.1 trillion RMB, right? That's about 200 billion Sing dollars, something like that, right? 150 to 200 billion Sing dollars in assets under management. That's really not small, right? One of the top fund managers in China, even. Next slide. And this master ETF that we are feeding into is a big ETF. It's actually the biggest MSCI China 50 ETF on the mainland. In terms of size, it's about 1 billion in Sing dollar terms, right? And is considered one of the best traded, that means the highest liquidity on the Shanghai Exchange. Okay, so this is just to give you some understanding of this. Okay, I think that should cover everything. I wanted to cover this briefly and concisely, and then maybe you want to